Hi everyone, in this video we will be going over A-Level Accounting 2020 February-March Paper 2 question number 1. This is the structured Paper 2 which consists of 4 questions. 2 of them are of 30 marks and 2 of them are of 15 marks, and we're also given a time limit of 1 hour and 30 minutes. And since question number 1 is of 30 marks, ideally we should be spending about 30 minutes in order to solve this question. And in this video as well, we will be attempting to solve this question under 30 minutes. So without any further delay, let's get started. The following information is available for S Limited for the year ended 31st December 2019. We are given the balances at 1st January 2019. For inventory and administrative expenses accrued, then we are given the amounts paid during the year. Alright, and this is for the year ended 31st December 2019. We are given the distribution costs, administrative expenses and purchases. Then we are given the amounts received during the year ended 31st December 2019. We are given the revenue. Then we're also given the balances at 31st December 2019 for inventory, administrative expenses prepaid, and 6% debenture. Alright, then we are also given some additional information. Inventory at 31st December 2019 included some damaged goods which had cost 5,000. So remember, in case of damaged goods in inventory, we should always subtract its cost because those inventory have now been damaged and it should not be included in its valuation, right? So previously, we had our inventory at 31st December 2019 to be 134,200, and now we should be subtracting this cost of 5,000 as it is of the damaged goods. So that's minus 5,000. Then these goods can only be sold for 3,000. So the next step would be to add the value at which these damaged goods can now be sold for, which means that we just need to add these 3,000 in order to figure out the correct valuation for inventory. After repairs costing 700, and repairs are definitely the expenses, right, which should be deducted. So we're again going to deduct that 700. And now this will give our correct inventory balance at the date of 31st December 2019. So let's calculate it. That's going to be 134,200 minus 5,000 plus 3,000 minus 700, which results in 131,500. Okay, so we're done with this information. Then for the second one, the 6% debenture, which is to be repaid in the year 2024, was issued on 1st September 2019. So this is given so that we can calculate our interest rates correctly. Alright, let's do that. We're talking about the year ended 31st December 2019, which means that for this particular year, we utilized this debenture for the month of September, October, November, and December. So we need to charge the interest for these 4 months. Let's figure it out. So we have the total amount of debenture to be 100,000. Then the rate of debenture is 6% per annum. So let's multiply it with that rate. We can write it down as 0.06. But remember that we only require the interest payment for the 4 months rather than the 12 months. So in order to figure that out, we just need to multiply it by 4 and then divide by the total number of months in a year, which is 12. Now this results in the interest payment of 2,000. Okay, we're also done with the second information. Now let's have a look at our first question. We need to prepare the income statement for the year ended 31st December 2019. Alright. So if you remember the format for our income statement, we always start with revenue. Okay, let's have a look above. We were given the amounts received during the year, which consisted of revenue, right? And that was of 998,400. So we just need to substitute this amount as revenue in our income statement. So that's 998,400. Then the next step would be to subtract our cost of sales in order to figure out the gross profit. So let's do that. That will be less cost of sales. And we always start with opening inventory. We then add all of our purchases for the year and subtract all of the closing inventory. And if there is any sort of carriage inwards, we also include that as our cost of sales. I don't think we are given carriage inwards in this question. Okay, for the value of opening inventory, we need to look at the balances at 1st January 2019. And the inventory is given to be 122,000. Let's substitute this amount. Now for purchases, it was given at the amounts paid during the year ended 31st December 2019. For purchases, we paid out 435,000. So we just need to include this amount in our income statement. So that's 435,000. And for closing inventory, we adjusted our damaged goods and figured out the revised value to be 131,500. So let's include this in our income statement. Alright, now we can figure out our total cost of sales by adding these three amounts. That's going to be 122,000 plus 435,000 minus 131,500, which results in 425,500. And since we need to deduct this amount of cost of sales, I'm just going to write it down in a bracket. Now we get our gross profit. And gross profit is just the difference between revenue and cost of sales, which in this case is going to be 998,400 minus 425,500, which results in 572,900. All right, now the next step would be to add any sort of incomes that we have. So let's have a look above. We can see that in our section for amounts received, the only income is of revenue, which means that we don't have any other incomes. So now we can jump towards our overhead section. Let's do that. So now we need to subtract all of our overheads. Let's have a look above. We can see that the very first expense that we paid out during the year was of distribution cost amounting to 84,475. And since this is the amount paid and not the actual distribution cost for this year, we need to adjust all of our accruals and prepayments to it. So let's have a look. We don't have any balances at 1st January 2019 representing distribution cost, and for the ending date we do not have any balance, which means that this actually represents the distribution cost for the year, which can be included in our income statement. So let's write it down. That will be our distribution costs of 84,475. Now the next one is given to be administrative expenses, and administrative expenses was of 298,875. And as we can see at the date of 1st January 2019, we have administrative expenses accrued, which means that these are the administrative expenses for the year 2018 that were not yet paid, which means that this amount of 3,875 was paid out of this amount, which we should not be including in this year's income statement. So I'm just going to exclude that amount by subtracting 3,875. Then we can also see that at the date of 31st December 2019, we have administrative expenses prepaid. So these are the prepayments for the next year, which means that these are the actual administrative expenses for the year of 2020, which should not be included in our income statement for the year 2019. So I'm just going to exclude this amount of 7,500 as well by subtracting it. Now this gives the administrative expenses to be included in our income statement to have the value of 287,500. Let's write it down. So that's going to be administrative expenses of 287,500. Now these are the only overheads. So let's figure out the total by adding these two amounts. That's 84,475 plus 287,500, which results in 371,975. Again, since these are the overheads that needs to be deducted, I'm just going to write it down in a bracket. Alright, now we can figure out our profits from operations. This is just going to be the difference between our gross profit and overheads, which in this case is 572,900 minus 371,975, which results in 200,925. Now the next step would be to deduct all of our finance costs, and after that we can figure out the profit for the year. And we already figured out the finance cost, which is just the interest for our 6% debenture, right? And the interest were only for the month of September, October, November, and December, which we figured out to be 2,000. Let's substitute this value. And since we need to subtract this finance cost, I'm just going to write it down in a bracket. Now, our profit for the year is just going to be the difference between our profit from operations and finance cost, which is 200,925 minus 2,000, which results in 198,925. This concludes the first part of this question. We can now move towards the second one. Okay, we were given the working section right here. So instead of scribbling all of the question paper in order to figure out the values, you guys should be showing all of your workings in this particular box so that you get your markings correctly. Now we are again given additional information. The following balances were also available at 1st January 2019. We are given the ordinary shares, share premium, and retained earnings. Okay, then we are told that an interim dividend of 0.08 per share was paid on 30 June 2019. Let's figure out the total dividend paid. It is just going to be the rate per share times the number of ordinary shares. And we're given the rate per share to be 0.08. And the formula for number of ordinary shares is just its value divided by the nominal rate. And in this case, we can see that the value of ordinary shares is given to be 100,000. And the rate per share is given to be 1. Which means that our number of ordinary shares is also going to be 100,000. Let's substitute this value in order to figure out the total dividend. So that will be 0.08 times 100,000, which results in 8,000. Alright, then for the second information, we're given that a bonus issue of 1 ordinary share for every 4 shares held was made on 31st October 2019. So we're told that for every 4 ordinary shares that we have, we will be providing 1 new bonus share. Right? Let's utilize our unitary method. So this just means that for 1 ordinary share, we'll be providing 1 by 4 bonus shares. And we know that we have a total of 100,000 ordinary shares. So let's figure out the corresponding bonus shares for this number. So that's going to be 100,000 ordinary shares. We'll be providing 1 by 4 times 100,000 bonus shares. So that is just going to be 25,000 bonus shares. And remember that bonus issue can only be done at the nominal rate, which means that our ordinary shares will now be increased by the number of bonus shares, that is 25,000 times our nominal rate of $1. So that's going to be 25,000. So this bonus issue brings in 25,000 additional capital to our ordinary shares. And remember that the bonus issue is always funded by our reserves, right? So the very first reserve that we will be utilizing is the share premium. And we can see that the share premium only has 20,000, whereas we require the amount of 25,000 in our ordinary share capital, which means that out of this 25,000, 20,000 will be funded by our share premium, whereas the remaining balance of 5,000 will be funded by our retained earnings. Alright, then for the third one, we're told that a final dividend of 0.09 per ordinary share was proposed on 31st December 2019. Remember, the key word here is proposed. So we have not yet paid this amount, which means that this does not affect our financial statements at all. We can just ignore this. Let's move towards the second part. We now need to explain what is meant by reserves were maintained in their most flexible form. So this just means that we should be using capital reserves before revenue reserves in order to facilitate future payments of dividends. Let's write it down. Using capital reserves before revenue reserves to facilitate future payments of dividends. And we're talking about the payments of dividends through the form of bonus issue. Like in this case, we know that we should be providing 25,000, right? So first we utilize our share premium, which is the capital reserve. And since this was insufficient to fund the entire amount of 25,000, we funded the remaining amount of 5,000 through retained earnings, which is a revenue reserve. This is an example of what is meant by reserves were maintained in their most flexible form. This concludes the second part, so we can now move towards the third one. We should now be preparing the ordinary share capital account for the year ended 31st December 2019. Since we are talking about the capital accounts, all of the opening balances will be on the credit side, which means that our balance BD will be on this side, and this is going to reflect the amount for ordinary share capital at the date of 1st January 2019, which was given above to be 100,000. So let's write it down. Now for the first information, we just provided our dividends, and this does not affect our ordinary share capital at all, so we can completely ignore this. And the second one was a bonus issue which brought in 25,000 into our ordinary shares. We already calculated it, right? And out of 25,000, 20,000 was funded by share premium and 5,000 was funded by retained earnings. So basically, the bonus issue is going to increase our ordinary share capital, and any increments are to be recorded on that side where we have our opening balance. And in case of ordinary share capital, we have the opening balance on the credit side, which means that this increment of 25,000 should also be recorded on that particular side under the heading of share premium, which will have the amount of 20,000, and under the heading of retained earnings, which will have the amount of 5,000. Let's write it down. So this is of share premium. The amount is 20,000. And then we have retained earnings with the amount of 5,000. And the very last information dealt with the final dividend proposed, which again does not affect our ordinary share capital, which means that these are the only items to be recorded. So we can move towards figuring out the closing balance. Since the opening balance is on the credit side, the closing balance will be on the debit side. So we first require the total, and clearly the heavier side is the credit side. So let's just add these three amounts. That's 100,000 plus 20,000 plus 5,000, which results in 125,000. Same for the debit side. And since we do not have any other items on the debit side, our balance CD, or the closing balance, is going to be 125,000 as well. Now the next step would be to write down this closing balance as the opening balance for next period. So that's going to be balance BD, which will have the exact same amount of previous closing balance, that's 125,000. This concludes the third part. We can now move towards the fourth one. We now need to prepare the statement of changes in equity for the year ended 31st December 2019. So firstly, we just need to write down our opening balances at the date of 1st January 2019. So this is balance at 1st January 2019. We had the share capital of 100,000. We had the share premium of 20,000. Let's have a look for retained earnings. That was 126,230. Now the total is going to be the sum of these three amounts. So that's 100,000 plus 20,000 plus 126,230, which results in 246,230. Now we just need to record the transactions that took place in between the time of 1st January 2019 and 31st December 2019. So we start with the dividend paid. And we already calculated its amount, right? So the dividend that we paid out was 8,000. And remember that dividend is the return given to the shareholders from all of our earnings, right? And the earnings are definitely included in our retained earnings in the form of profit, which just means that we need to deduct this 8,000 from the retained earnings column. Let's write it down. So that's going to be 8,000. So the total will also have 8,000. And dividends does not affect our share capital as well as share premium. Then the next transaction was that of bonus issue. Let's have a look. We already calculated that bonus issue will bring in 25,000 to our ordinary share, and now we need to deduct 20,000 from share premium and 5,000 from retained earnings. Let's do that. So that's going to be 25,000 addition to share capital, 20,000 deduction from share premium, since this is used to fund this bonus issue, and 5,000 deduction from retained earnings. And always remember that the total for our bonus issue is always going to be 0. All right, then we don't have any other transaction, but remember that we already figured out the profit in the first part, right? We figured out our profit for the year to be 198,925, which should be added to our retained earnings in the statement of changes in equity. So let's do that. That's going to be profit for the year with the amount of 198,925. And profit for the year does not affect share capital and share premium at all, which means that the total is also going to remain the same. Now we can move towards figuring out the balance at the closing date. So that's going to be balance at 31st December 2019. For share capital, that's going to be the sum of these two amounts, 100,000 plus 25,000, which results in 125,000. For share premium, that's going to be the sum of these two amounts, 20,000 minus 20,000, which results in 0. For retained earnings, that's the sum of these four amounts. That's 126,230 minus 8,000 minus 5,000 plus 198,925, which results in 312,155. And for the total, that's the sum of these three amounts, 246,230 minus 8,000 plus 198,925, which results in 437,155. In order to figure out this amount, we could have also added these two amounts. Alright, this concludes the fourth part of this question. We can now move towards the fifth one. We're again given additional information. The directors are planning to acquire more machinery in the following year and require a further investment of 50,000. They are considering two options. So either we can issue an additional 6% debenture in order to get this 50,000, or we could make a rights issue of one ordinary share for every 5 shares held at a premium of 1 per share. Now we need to advise the directors on which option they should choose. Okay, let's talk about option 1 first. Option 1 deals with debentures, right? So debentures are the loan capital which is repayable in the future. Let's write it down. Loan capital which is repayable in the future. And if we are to issue 50,000 debenture at the rate of 6%, we also need to make interest payments. So let's figure that out. The interest is just going to be the amount of debenture times the rate. And remember that this is the annual interest. So that's 6%, which you can write down as 0.06. And this results in an amount of 3,000. So if we were to issue this additional debenture, we would require to make an interest payment of 3,000 annually. Let's write it down. Interest of 3,000 will be payable annually. And when we issue debentures, the debenture holders are not provided with any sort of voting rights, which is an advantage for the company since there will be no dilution of control. Let's write it down. No voting rights for debenture holders. And since we are issuing additional debenture, this is going to increase the external borrowings. And this in turn will increase the gearing ratio of the company, which might not always be a good thing. Let's write it down. Increases external borrowing, which then increases the gearing. And finally, in order to issue these debentures, we require security or collateral. Let's write it down. Security or collateral is required. Now let's talk about option 2. Option 2 deals with rights issue. And these rights issue will give rise to ordinary shares, which are permanent capital. And these are not repayable. Let's write it down. Permanent capital, which are non-repayable in nature. Then we already wrote that interest payments of 3,000 will be required for debentures. But in case of rights issue, these are ordinary shares, right? So the dividend payments can be discretionary, which means that there is no any fixed payment to be made towards the shareholders. Let's write it down. Dividend payments is discretionary. Then we talked about voting rights, but in case of rights issue, again, we're talking about ordinary shares, which means that those shareholders will have voting rights. So shareholders get voting rights. And since we are bringing in more of ordinary share, this definitely means that this is going to increase the equity holding. Let's write it down. Increases equity holding. And whenever there is an increment in equity holding, this will decrease the gearing ratio. So let's write it down, which then decreases the gearing. All right. And in case of shares, we do not require any sort of security or collateral. So security or collateral is not required. Now, based on these factors, we now need to advise the directors on which option they should choose. So there is no correct answer for these kind of questions, but personally, in this case, I would always go towards rights issue of shares. So in this case, I will be advising the directors that they should go with option 2. Let's write that decision down clearly. The directors should choose option 2. Okay, this concludes the 5th part of this question as well as the entire question number 1 of 2020 February-March paper 2-2. If you found this video useful, make sure you like the video and leave a comment below, and make sure you're subscribed to the channel and hit the bell icon so that you do not miss any of these videos in the future. Thank you.